Bismillahirrahmanirrahim. This is the third video on drilling and development cost under successful efforts method, and in this video we are going to solve exercises comprehensively on cost to be capitalized or expensed in case of drilling an exploratory well. We will also explain how to generalize transactions on depreciation on equipment used in development well, acquisition of individually significant unproved leases, proved and unproved leases, and generalizing acquisition of significant unproved properties. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the oil and gas companies and want to refresh their learning on generalizing exploratory drilling cost, development cost, generalizing additional development cost, and other drilling operations. So let us start with solving an exercise on determining whether cost to be capitalized or expensed in case of drilling an exploratory well. Falco Oil Company began operations in 2017. During that year, Falco drilled an exploratory well on a lease located in a remote area where any oil discovered would need to be transported via a pipeline. The well found reserves, but not enough to justify building a necessary pipeline. The company does not plan to drill any additional exploratory wells at this time. How should the cost of the well be handled? Now, although the well has found reserves, but since it is not enough to justify building a pipeline, and the company do not plan to drill any additional exploratory wells, so the cost of the well should be expensed. Let us look into another illustration. Allen Petroleum drilled an exploratory well in 2018 that was still in progress at year end. Total cost incurred by 31st December 2018 were 500,000. During January 2019, drilling was continued and additional cost of 230,000 were incurred. Total depth was reached and well was determined to be dry by the end of January. Assuming Allen's financial statements are not published until early February, what cost, if any, should be expensed for 2018 and for 2019? So for 2018, we are going to expense 500,000, and for 2019 we are going to expense 230,000. Next, let us see how to calculate interest capitalization amount and how to record interest expense. Now, unproved property cost relative to the Williams lease were 40,000 at January 1, 2019. During 2019, $400,000 of drilling costs were incurred on the Williams lease, and 8% 500,000 note is outstanding during the entire year and was obtained to finance the drilling program. Compute the interest capitalization amount and record the interest. Now, capitalizing interest is a part of the cost of the assets, and to obtain the amount of interest to capitalize each period, the interest rate selected is applied to the average amount of accumulated capital expenditures. Specifically, capitalized interest is calculated as average accumulated capitalized expenditure during the construction times interest rate times the construction period. The average accumulated capitalized expenditure is calculated by adding the beginning balance, that is 40,000, and ending balance, that will be 400,000, the beginning plus 40, that is 440. So this will be 40,000 plus 440,000 divided by 2 times the interest rate, that is 8%, and the construction period is 1 year. So this will be equal to 19,200. So the wells in progress intangible drilling cost will be recorded for 19,200, and interest expense will be credited by 19,200. Let us solve one more exercise in this regard. Now, equipment used in testing and completing a development well cost 50,000 and has a 10-year life with a salvage value of 5,000. The equipment is classified as support equipment and facilities. The equipment was used for 4 months in drilling Kelly number 1. Ignore the wells in progress account and use the appropriate final account, and we have to record the depreciation. So first of all, the cost is 50,000 and the salvage value is 5,000. So we are going to subtract this amount. We have 45,000, and the period or the life of the asset is 10 years. So the annual depreciation is 4,500, and we have to calculate for 4 months. So into 4 upon 12, that will give us 1,500. So wells and equipment intangible drilling cost will be debited by 1,500, and accumulated depreciation support equipment will be credited by 1,500. You can see that we do not record debit depreciation expense, but rather wells and equipment intangible drilling cost. Next, let us solve another exercise on depreciation on equipment used in development well. An exploratory well has the following costs that are appropriately assigned to the well. Depreciation on support equipment is 5,000, so the accumulated depreciation is 5,000, and then we are incurring operating cost of 12,000, so we have paid 12,000 for that cash, and wells in progress intangible drilling cost is credited by 17,000. Now record the above amount assuming the well was dry, and when the well is dry it is going to be expensed. So dry hole expense is debited by 17,000, and wells in progress intangible drilling cost is credited by 17,000. Next, let us solve an exercise on generalizing acquisition of unproved properties. Now, Tate Corporation made the following transactions relating to an unproved property during 2018. Zephyr 1 was drilled with intangible drilling cost of 400,000. So this is an intangible drilling cost of 400,000. And equipment cost of 80,000. So cash is credited by 480,000. The well was determined to be dry and was plugged and abandoned at a cost of 10,000. So wells in progress intangible drilling cost is debit by 10,000 and cash is credit by 10,000. Salvage equipment placed in inventory was valued at 5,000. Now just keep in mind that in case of exploratory well, the cost of plugging and abandoning in addition to the capitalized cost in the wells in progress account, net of any salvaged equipment must be written off to a dry hole expense. So dry hole expense is going to be debit, and now it is going to be debit by 410,000. You can see we have a debit of 400 over here and debit of 10,000 over here. Then dry hole lease and well equipment is 80, but then it is salvageable for salvage for 5,000. That means lease and well equipment will be debit by 75,000 and the 5,000 will be debit for the inventory equipment. Okay, and then wells in progress intangible drilling cost will be debit by 410,000 and wells in progress lease and equipment account will be credited by 80,000. Next, let us solve another exercise on generalizing proved and unproved leases. Now, lease A, we have 4 leases over here, A, B, C, and D. 2 of them are unproved, while 2 of them are proved over here. And let us see how we are going to record. Now, acquisition cost is for lease A and lease B because these are the one we are acquiring. So that is unproved property lease A is debit by 30,000 and unproved property lease B is debit by 35,000 and cash will be credit by 65,000. Next we have lease A, and you can see that this is an exploratory type and we have incurred some drilling cost over here, and there are 4 costs. Of these, 2 of them are intangible drilling cost. So wells in progress intangible drilling cost is debit by 190,000, 180 plus 10, and casing and production and equipment is 0, so that makes 30,000 and cash is credited by 220,000. For lease B, this will be intangible drilling cost will be debit by 215,000 and lease and well equipment will be debit by 110,000 and the total will be 325,000. We go to lease C, and for lease C we have wells in progress intangible drilling cost debit by 172,000 and wells in progress lease and well equipment will be debit by 28,000 and cash will be credited by 200,000. For lease D, 190 plus 14, that is 204 for intangible drilling cost, and 222 plus 80, that is 102 for lease and well equipment, and the total will be 306,000. Okay. Next, let us see the drilling results. And the first thing we can see is that lease A is the well is dry and it is going to be abandoned. So all the capitalized cost is going to be these are the cost, they are going to be expense. So dry hole expense is debit by 190,000 and dry hole lease and well equipment expense again is 30,000 and wells in progress, we have to close this. So 190 and 30. Okay. Then you see, for lease A, because this is dry and we have already incurred an acquisition cost of 30,000, and this will be recorded under the surrendered lease expense for 30,000. We move on to number B now. For number B, it is found proved reserve. That means the well in progress are going to be transferred to wells and equipment. So wells and equipment intangible drilling cost is debited by 215,000, and wells and equipment will be debited by 110,000, while the well in progress are going to be credited by 215,000 and 110,000. Further, you can see that because we have found the reserves, in the case of lease B. That means that the unproved property of lease B will be reclassified as a proved property. So proved property is debited by 35,000 and unproved property lease B is credited by 35,000. Let us move on to lease C, and for lease C, this is a well is dry, so we attach the same as it is for lease B. Okay. Now you see, if you look into lease A was in the exploratory stage, while in lease C this is in the development stage. So obviously the wells and equipment are going to be debit, and the wells and in progress are going to be credit. As so wells and equipment intangible drilling cost will be debit by 172,000, and lease and well equipment will be credited by 28,000, and wells in progress intangible drilling cost will be credit by 172, and lease and well in progress lease and well equipment will be credited by 28. Then we move on to lease D, and for lease D we have wells and equipment intangible drilling cost, and this is found a proved reserves again. And when they have found proved reserves, so yes, I would like to add over here that for lease D, this is a development well, and we have found proved reserves. And once we have found the proved reserves, so wells and equipment intangible drilling cost is debit by 204, and wells and equipment will be debit by 102, and wells in progress is going to be credited by 204, and wells in progress lease and well equipment will be credited by 102. Okay. Finally, something I would like to add at this stage, and something is very interesting. If you look at lease A, we have expensed when the well was declared dry. But when we go for lease C, when the well was declared dry, we have debited the wells and equipment. And the reason is that in the case of lease C, it is not in the well type is not exploratory. Here it is development, and here it is exploratory. So exploratory are going to be expensed, while the development wells are going to be capitalized. So just keep this thing in mind. In addition to this, if you look into for lease A, or rather I should show you for lease B, sorry, because they are similar. We have reclassified the unproved property as a proved property, but when you look into lease D, we have not done similar journal entry, because although in both the cases it has found proved reserves, and the reason is that in the case of lease D, it is at the development stage. So we have already made we have reclassified the unproved property as a proved property when it was in the exploratory stage. But for lease B, you can see that this is in the exploratory stage. So once it is proved reserves are found, we reclassify unproved property as a proved property. Okay, we are continuing with this illustration. No. So this completes this exercise over here, and we move on to the next one, and here we are going to look into how to make journal entries in case of acquisition of significant unproved properties. We have already explained what are significant and what are insignificant properties. So over here, William Petroleum, a new successful efforts company, began operations in 2018 with the acquisition of 4 individually significant unproved leases. Give the entries assuming the following transactions. You may combine entries for items marked with an asterisk. So we have marks with an asterisk and we can combine them. So let us see how to do that. First of all, there is a lease bonus. So that is 50 plus 40 plus 70 plus 55. So this is unproved property, debit by 215,000, and cash is credit by 215,000. Then we have G&G expenses, 60 plus 50 plus 75 plus 90, that makes 275,000. G&G expense debit and cash is credit by 275. Next we look into the drilling cost for there is no further transactions to be done for lease A, so it is done over here. We move on to lease B, and lease B, this is at the exploratory. All the other 3 are at the exploratory stage, and they have incurred the cost of 300 and 125. So wells in progress, intangible drilling cost is debit by 300,000, and wells in progress lease and well equipment is debit by 125,000, and cash is credit by 425,000. Now the drilling result for lease B is that the well is dry, and when the well is dry, the drilling cost are initially reclassified as temporarily classified as temporarily as wells in progress intangible drilling cost. But in this case now we have a dry hole, and in case of exploratory well, the cost of plugging and abandoning in addition to the capitalized cost in the wells in progress account, net of any salvage equipment, must be written off to dry hole expense. So the journal entry is going to be dry hole expense is debit, and this will be debit by 300,000, and lease dry hole expense, lease and well equipment will be debit by 125. while wells in progress is going to be credited by 300 and lease and well equipment by 125,000. Then at this stage there is a lease impairment of 25%. So 25% of the lease bonus, that is 40,000, is 10,000. So we have a lease impairment expense of 10,000 and there is will be allowance for impairment will be credited by 10,000. Let us move on to lease C. And for lease C, we have the well intangible drilling cost and the equipment cost of 250. So wells in progress intangible drilling cost is debit by 250 and wells in progress lease and well equipment is debit by 50 and cash is credit by 300,000. We move on to lease D, and in case of lease D, well in progress intangible drilling cost is debit by 150 and equipment is debit by 40 and cash is credit by 190. Okay, let us move on further for this illustration and we are continuing. Now we have in the year 2019 they have paid delay rental of 4,000 and 3,000, that makes 7,000 and cash is credited by 7,000. Then we have for the lease A, we have the drilling cost for 275 and 50. So we have wells in progress intangible drilling cost debit by 275,000 and wells in progress lease and well equipment is debit by 50,000 and cash is credit by that the total is going to be 325,000. Now the result, the drilling is completed and a proved reserve is found. So first of all, we are going to capitalize it, or it is going to be transferred to wells and equipment, intangible drilling cost and lease and well equipment cost. Now if you can remember that if proved reserves are found, then both the well in progress accounts will be transferred to wells and related equipments and facilities. So wells and related equipment is going to be debit by 275,000 and wells and equipment lease and well equipment is debit by 50 and wells in progress will be credited by 275 and wells in progress lease and well equipment will be credited by 50. Now in addition to this, now remember that since this is the first successful exploratory well drilled on this property, so the unproved property account will be reclassified, or you can say it is going to be transferred into a proved property account because proved reserves has been found. So proved property is going to be debit and this is going to be debit by let us see how much was it was 50,000. So proved property is debit by 50,000 and unproved property is credit by 50,000. We have already recorded this bonus, but we cannot see because we have made the total for all the four leases. Then for lease B, now we have the well cost and we have wells in progress, intangible drilling cost and lease and well equipment, that is 225,000 and 50,000. So the cash will be credit by 275,000. The result for lease B is that it is a dry hole and we are going to abandon. So if we are going to abandon, then first of all the dry hole expense, intangible drilling cost, they are going to be closed, and it is going to be expensed by 225,000 and 50,000, and this is going to be wells in progress 225,000 and 50,000. Now just keep one thing in mind, that if the lease is significant and is abandoned, you can see that this is a significant lease and it is abandoned, then the net amount to be capitalized will be how much? Now if you can remember, here we have 40 and we have an impairment of 10,000, so that makes 40 minus 10, that is 30,000. So the allowance surrendered lease is expense will be for 30,000. There was already an allowance of 10,000, so this will be debit by 10,000, and unproved property will be credit by 40,000. Let us move on to lease C, and for lease C there is no intangible, no well in progress account, so the wells results are still undetermined and capitalization criteria are no longer met, so the well must be written off. See, it is undetermined, so both criteria are not met, so we have to write off, and when we write off we debit dry hole expense, and this is for lease C. Now dry hole expense will be for lease C 250 for intangible drilling cost and 50,000 for equipment cost. So dry hole expense will be 250 and 50, and well in progress will be 250 credit, and lease and well equipment will be credited by 50. Then we move on to lease D, and in lease D uh, and we have the intangible drilling cost, so we have the intangible drilling cost of 60 and 40, and cash is credited by 100,000. And then the result, the drilling result is drilling is completed and it is a proved reserve, and when it is a proved reserve, so it is going to be capitalized. Now if you look into lease D, over here we have intangible drilling cost of a intangible drilling cost of 150 and 40, so we will add 150 to this 60, that makes 210, and 40 for equipment and 40 over here, that makes 80,000. So we have wells in progress intangible drilling costs credit by 210, and wells in progress lease and well equipment credit by 80. Now just see that, you see this was a exploratory well, and now it is a proved reserve, so we have to reclassify the unproved property as a proved property for 55,000. Okay, so let us move on to further. Now let us see what happens in the year 2020. Now in the year 2020, there is no delay rental for A or B. There is a delay rental for C of 3000, and since we can add them up, so delay rental expense is 3000 and cash is credited by 3000. Then drilling cost, nothing is there for, but for lease A, now this is in the development stage. Just keep this thing in mind. And they have intangible drilling cost of 300,000 and 80,000. That makes 380,000. And then we come up with the result, and the result is that it is a dry hole. And when it is a dry hole, again you can see we are not going to expense, but it is going to be capitalized because this is a development well. So wells and equipment intangible drilling cost will be debited by 300,000. Wells and equipment lease and well equipment will be debited by 80,000. Wells in progress will be credited by 300,000, and wells in progress lease and well equipment will be credited by 80,000. Next we move on to lease D, and let us see what has happened in case of lease D. Now in lease D, again this is a development well. We have incurred some cost, so we have 250 and 100, and the cash will be credited by 350,000. Now drilling is completed and it is a proved reserve. Here it was a dry, now it is proved, and both of them are development wells. So again this is going to be capitalized, and wells and equipment intangible drilling cost will be debited by 250, and lease and well equipment will be debited by 100,000, and wells in progress intangible drilling cost will be credited by 250, and wells in progress lease and well equipment will be credited by 100,000. Now just keep one thing in mind, that since this is a development well, so there is no reclassification of unproved property to proved property because it is already a proved property. Next, let us solve one more exercise on generalizing acquisition of significant unproved properties. Now, Garvin Oil Company incurred the following cost during the year 2018 and 2019. Now, this is the information for the year 2018. Contracted and paid 50,000 for G&G surveys during the year. So G&G expense is debit by 50,000 and cash is credit by 50,000. Now lease acreage in the four areas as follows. For Merrow lease, it is 500 times 50, and there is acquisition cost of 200, so that makes 500 times 50 plus 2,000, that is 27,000. Then for Richard lease, we have 800 times 100 plus 3,000, so that is going to be 83,000. Then for Onyx lease, we have 200 times 60 plus 500, that will be 12,500. Then for ROP lease, 600 times 30 plus 800, so that is going to be 18,800. Okay. Now we move on to transaction number C. The company also leased 10 individual tracts for a total consideration of 60,000. The tracts are considered to be individually insignificant. So the difference between B and C are B is significant and C is insignificant. So again we have the same general entry, but don't forget when it is insignificant we have to add Group control, so unproved property group control is debit by 60,000 and cash is credit by 60,000. Then they have incurred 1,000 for to maintain lease and land records. So record maintenance expense is debit by 1,000 and cash is credit by 1,000. Okay. Now we have during the year 2018, the company incurred the following cost in connection with the Maxwell lease. Now these are a list of costs, and you can see that some of these costs are intangible drilling cost, while some of them are the lease and well equipment costs. So we have to look into which one of these are intangible drilling costs. We have 18,000 and 2,000. These are intangible. 18,000 and 2,000, while drill pipe, conductor casing, wellhead equipment, these three are lease and well equipment, that is 18,000, 10,500 and 28,000. Then contractor charge and drilling, so this is a intangible drilling cost. Rentals is intangible. Water, fuel, power, lubricant intangible. Drill bits intangible. Electric, logging, cement, cementing services, casing, installation crews. So all these are intangible drilling costs. So that is 737,000, 30,000, 70,000, 19,000, 20,000, again 20,000, then we have 15,000 and 40,000. And then if you look into the surface casing, obviously surface casing is a lease and well equipment cost of 326,000. So if we make the total of this will be 971,000 and this is 89,100. Then we have the completion cost, and the completion cost again they have been classified into intangible drilling cost and lease and well equipment cost. So you can see that production casing, Christmas tree, tubing, all these three are lease and well equipment costs. So 151, 500, 22,000 and 37,500. Then we have labor intangible cost. Perforation cost is again an intangible cost. So 20,000, 1,000 and 40,000. And then we have flow lines, and so flow lines is 45,000. And then we have labor for installing flow lines. Now this labor will be classified as a intangible drilling cost because this is after the Christmas tree. So this is 8,000, and you can add, the total will be 61,000 and 264,000. Next we are going to make the journal entry for this. So we have wells in progress intangible 971 plus 61, that is 1,032,000, and wells in progress lease and well equipment, that is going to be 353,100. So this is 1,385,100. Okay. Now the next interesting thing that you can observe is that there is a completion cost, and when we are completing, it means it is proved now. So it is going to be capitalized. So wells and equipment intangible drilling cost will be debit by 1,032,000, and wells and equipment lease and well equipment will be debit by 353,000, 353,100, and these two costs are transferred actually into wells and equipment lease and well equipment. So 1,032,000 and 353,100. Now remember that because drilling is completed, and then both well in progress account balances, both of them are going to be transferred to wells as we have done over here. And now we are going to look into, you see, this was a proof property of, this is for Maxwell, and let us see where is Maxwell over here. Richard Onyx. Maybe I have used the Maxwell. This should be Maxwell. Let us make, okay, I will make this one as Maxwell. Oh, sorry, Marrow. Just Marrow. So this was a unproved property, and this will be reclassified as a proved property, 27,000. Okay. Let us go further. An exploratory well was drilled on the Richard Lease in 2018 on a turnkey basis to 9,000 feet. The contractor charged 3,000, which included 40,000 for casing. So 40,000 is lease and well equipment, and the balance will be 260,000, and the cash will be 300,000. At the end of the year 2018, the ROP lease was impaired by 40% and Onyx lease by 20%. The company has a policy to maintain an allowance for impairment equal to 60% of individually insignificant leases. So first of all, we will look for the significant leases. Now, if you look at ROP, for ROP, it is 18,800. So 18,800, and it is going to be 40%. So 40% of 18,800 will be 7,520, and allowance for impairment will be credited by 7,520. Then we look into Onyx, and for Onyx we can see that Onyx, the unproved property is 12,500, and we are impairing 20%. So 20% of 12,500 is 2,500, and allowance will be credited by 2,500. In case of individually insignificant, we are impairing 60%. So 60% of, you can see insignificant was 60,000. Group we can see here group control. So that is going to be 60% of 60,000 will be 36,000. Okay. Then for delay rental were paid on the Onyx and ROP leases, and for delay rental Each lease has a delay rental clause requiring payment of 10 per acre if drilling was not commenced by the end of the year. So we have the delay rental of 200 and 600 because this is for um, Onyx and ROP. So Onyx is 200 and ROP is 600. 10 per acre, that means 6 plus 2 is 800. 800 times 10 is 8,000. Okay. Late in 2019, the company abandoned the Onyx lease and two of the individually insignificant leases, which cost a total of 8,000 when acquired. The ROP lease is now considered to be very valuable lease because a large producer was found on adjacent property. Okay, so first of all, we are going to record the abandonment of Onyx. So we should remember that when an individually significant unproved property is surrendered or abandoned, then its capitalized acquisition cost should be charged against the related allowance for impairment account. And for properties assessed individually, abandonment results in the net carrying value, that is the acquisition cost minus the impairment allowance of the abandoned properties being expensed. So that's why if you look into Onyx, we have done the impairment over here for Onyx for 2,500. Allowance was credit and this is going to be debit now by 2,500. And then we have this, the balance unproved property of Onyx was 12,500. So this is going to be unproved property of 12,500 and the balance will be surrendered lease expense. Now in case of individually insignificant, the allowance is given as 8,000 and unproved property will be credited by 8,000. Then at year end, the company still could not decide whether to complete or abandon the well on the Richard lease, and both criteria for delaying classification of the well were no longer met. So if their criteria is not met, that means it is a dry hole and the cost of drilling an exploratory well should be expensed. Now we can see that for Richard lease, we have well in progress debit by 260 and 40, and now this will be a dry hole expense of 260 and 40, and this will be again 260 and 40. Next, let us solve another exercise on journalizing. And Aggie Oil Corporation, a new successful efforts company, incurred the following cost and made the other transactions shown below for the year 2018 and 19. Paid 225 for G&G cost. So when we are paying expense, so G&G expense is debit by 225,000 and cash is credited by 225,000. Then lease acreage in three individually significant areas as follows: Mary lease, Batch lease, and Highland lease. So we have three leases. These are unproved properties. 100 or 1000 times 60 plus 3000, that will be 63,000. Then 800 at the rate of 70 plus 10,000, that will be 70 plus 800 is 5,600, sorry, 56,000 plus 10,000, that will be 66,000. Then we have unproved property, 600 times 60, that is 36,000 plus 8,000, that makes 44,000, and cash will be credited by 173,000. Then the company also leased 20 individual tracts for a total cost of 80,000. These are considered to be individually insignificant and are the first insignificant unproved property acquired by Aggie. Now this is an insignificant, so that's why we have to represent them by writing group control. So unproved property is debit by 80,000 and cash is credit by 80,000. Paid 5,000 in cost to maintain lease and land record in 2018, and also paid 30,000 to successfully defend a title suit. So we have record maintenance of 5,000, and there are legal expenses of 30,000, and we are paying cash, so cash will be credited by 35,000. Okay. Then paid the following cost in connection with batch number 1 is successful. Now this is a successful well. So once again we are going to classify them, these costs, between intangible and drilling cost. So G&G cost is a intangible drilling cost, so this is going to be 5,000. Then location and road preparation prior to spudding in the well, so that is going to be the lease and well equipment, that is 6,000. Then we have surface damages of 16, so this is going to be intangible surface damage. Then we have surface casing, then we have contractors fees, okay, equipment rental, drilling fluids, fuel, drill bits, cementing services, roast about labor, hauling and transportation, production casing. Okay, now you see production casing will be the lease and well equipment, tank, battery, lease and well equipment, flow lines, pumping units, casing, tubing, separating and treating, measuring equipment, downhole pump and roads. Testing and acidizing will be the intangible drilling cost. So we have 5,000, we have then 6,000, 16,000, 200,000, 100,000, 40,000, 10,000, 20,000, 5,000, 9,000, 8,000, and what else? And 11,000. Then we have 6,000, 36,000, 36, 11, 5, 50, 7, 13, 12, 1, and 4. So if we make the total, 5, 6, 16, 200, 40, 10, 25, 9, 8, 11. Okay. So now if we make the total will be 430,000 and 145,000. So wells in progress, intangible drilling cost is debit by 430,000. Wells in progress, lease and well equipment will be debit by 145,000, and cash will be credited by 575,000. Now Now, since this is a successful well, so the both well in progress will be transferred to wells and related equipment and facilities account. So wells and equipment will be debited by 430,000 and 145,000, 430,000 and 145,000. Now then we have the batch lease. You can see over here. You can see for this was batch, and the batch lease amount is 66,000. Now because it is proof successful, that means we have to reclassify the unproved property to a proved property, 66,000. Okay, we go to number F. An exploratory well was drilled on the Highland lease in 2018 on a turnkey basis to 8,000 feet. The contractors charge 400,000 charge of 400,000 was paid. So we have the charge included 60,000. That means 60,000 is lease and well equipment, and the balance of 340,000 is intangible, and the cash will be credited by 400,000. At the end of 2018, the decision has not been made to complete or abandon the well. Both criteria for delaying classification of the well were met. Okay, they were met. At the end of 2018, the Mary lease was impaired 60% and the Highland lease by 30%. The company policy is to maintain an allowance for impairment of 70% of the cost of insignificant leases. Now, for Mary, we have the 60%, and we can see over here for Mary, it is 63,000. So 60% of 63 is going to be 37,800. For Highland lease, it is 30%, and for Highland it is 44,000. So 30% of 44 will be 13,200 as impairment expense, and allowance will be credited by 13,200. Then 70% of insignificant leases. Now if you can remember, the insignificant leases was for 80,000, and this is 70%. So 70% of 80 will be 56,000. Okay. Then during 2019, the Mary delay rental of 2,000 were paid on the Mary lease, 1,200 on the Highland lease, and 3,000 on group. So we have 2,000 plus 1,200 plus 3,000. So there is a delay rental of 6,200, and cash is credited by 6,200. Then we have Mary lease was abandoned, and 3 of the individually insignificant leases cost 8,000 were also abandoned. So first of all, you can see that we are abandoning the Mary lease, and Mary lease was for 63,000. So unproved property is credited by 63,000. If you can remember, for Mary lease there was allowance of 378, and this is going to be debit now by 37,800, and the balance will be recorded for surrendered lease expense 25,200. For the group, there is they are saying 8,000. So allowance for impairment group is 8,000, and unproved property group control is credited by 8,000. At year end, the company has not made a decision to complete or abandon the Highland well. Both criteria for delaying classification of the well were no longer met, and then it has to be expensed now. So this is about Highland. So Highland, we have dry hole expense. Sorry, Highland. Where is Highland? It is 340,000 and 60,000. So dry hole expense is debit by 340,000 and 60,000, and wells in progress is credited by 340,000, and wells in progress lease and well equipment is credited by 60,000. So this completes the illustration on generalizing drilling and development cost under successful efforts method. We have solved illustrations comprehensively on generalizing exploratory drilling cost, development cost, additional development cost, and other drilling operations. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.